Welcome back to the Deep Dive. Today, we are shifting gears. We are going full talk tickers mode.
That means no fluff.
Exactly, no fluff. We're getting right into the institutional grade breakdown of earnings season. It is late January 2026. The holiday fog has finally lifted, and we're turning our attention to the American Midwest. Specifically, a bank that is making a lot of noise in a sector that, usually prides itself on being quiet.
We are looking at Equity Bank shares, ticker symbol EQBK, based in Wichita, Kansas.
And the reason we pulled this file is that while the rest of the regional banking sector has been sort of licking its wounds or just sitting on their hands waiting for the Fed to save,
right, waiting for rate cuts,
these guys have been on the warpath.
Warpath is the right word. I mean, they're aggressively manufacturing growth. They aren't waiting for the macro environment to get better. They are buying their way to scale.
And the report we have in front of us, the Q4 2025 earnings, is essentially the report card on a transformative year. They grew the balance sheet by almost 50% in 12 months?
Which is massive. If you're a $5 billion bank and you suddenly become an $8 billion bank, the plumbing changes, the risk profile changes. I mean, everything changes.
And the big question hanging over this entire earnings call was just, can they digest what they just ate? So let's unpack the headline numbers first. They reported on January 22nd. Adjusted EPS came in at $1.21.
Which is a significant beat.
It is, depending on whose desk you're looking at. The consensus was hovering anywhere from $0.88 to $1.15. So they comfortably cleared the bar.
And even on a GAAP basis, earnings per share were $1.15. Top line revenue hit $73.03 million, up over 25% year over year.
Net income, $22.1 million for the quarter. On paper, these are very solid growth-oriented numbers. But here's where it gets really interesting. This is the tell we always look for on talk tickers. The market reaction.
Right.
You drop a beat like that, you show 25% revenue growth.
Right.
Usually you'd expect a pop. You'd expect a nice green candle.
We didn't see that.
No. We saw a fade. The stock opened around $49.72, actually touched $50 briefly, and then just slid all day to close at $48.90, down about 20 basis points.
And the volume was there too. We saw about 225,000 shares trade hands versus their average of around 80,000. So people were paying attention.
They were active.
But they were selling the news.
Why? I mean, if the numbers are good, why sell?
It signals caution. Investors see the headline growth, but they are wary of the execution risk. We are talking about a bank that is integrating massive acquisitions simultaneously.
So the market is saying, okay, you bought the growth, now prove you can run it.
Exactly. Prove you can run it efficiently without blowing up your cost base. It's the show me phase.
And I think to understand that hesitancy, we have to look at the mechanics of that efficiency. Let's talk margins. In this rate environment, net interest margin, or NI, is the holy grail.
It's everything.
So how did they hold up?
Better than expected, actually, but you have to look under the hood. The headline, NIM expanded slightly to 4.47%. That's up 2 basis points quarter over quarter.
4.47% is a healthy number for a regional.
It is very healthy. Most peers would kill for that. But you have to be careful with that number because of purchase accounting.
Right. The M&A can distort it.
Yeah, you buy a bank, you mark their assets to market, and that accretion can artificially inflate the margin. It's just, it's noise.
It's not run rate revenue, it's accounting magic.
Exactly. But management was very specific about this, which I appreciated. They highlighted a core margin of 4.36%. That strips out all the purchase accounting.
So even without the deal magic, the core business is stable.
It is. And the driver there is interesting. It's on the liability side of the balance sheet. Their funding costs, what they pay for deposits and borrowings, dropped by about 10 to 12 basis points.
That's significant. That's the benefit of the rate cycle finally starting to turn.
Right. And at the same time, their asset yields held up because they've been repositioning their bond portfolio. They aren't stuck holding low-yield paper from 3 years ago.
That repositioning is key. But I want to pivot to the sheer size of the change here, because talking about margins is fine, but the denominator has just exploded. They started 2025 with $5.3 billion in assets.
And ended with $6.4 billion.
And that $6.4 billion doesn't even include the main course.
Exactly. That number is almost misleading because of the timing.
Yeah.
Right. On January 1st, 2026, literally just after the quarter closed, they finalized the acquisition of Frontier, a bank in Nebraska.
And that deal dumps, what, another billion plus on the balance sheet?
Another $1.34 billion in loans and $1.1 billion in deposits. So if you do the math, right now, as we speak, they are operating a bank with roughly $7.8 billion in assets.
Which is a completely different weight class than where they started 2025. I mean, you're approaching that $10 billion regulatory threshold soon.
And this is where that operational risk comes right back in. During the call, they talked about the complexity. They aren't just integrating Frontier.
They're still finishing up the NBC deal out of Oklahoma.
It's a multi-front war. And that is exactly why the market faded the stock. The complexity of merging systems is high. They said the Frontier Systems conversion is scheduled for mid-February.
That's really soon.
It is incredibly fast, and that's the danger zone. If you screw that up, if debit cards stop working, if online banking goes down,
you lose customers.
You lose customers, and then you lose that projected efficiency you promised Wall Street.
That's high stakes, poker. Speaking of customers, let's talk credit. Because usually when a bank grows this fast, you assume they are just buying revenue by taking on bad loans.
That's the classic trap. Growth at any cost.
Right. Did you see any evidence of that here? Because with 50% growth, you expect some slippage.
Actually, no. And this was arguably the most bullish part of the call. Rick Sims, the bank CEO, was pretty adamant that credit is pristine, and net charge-offs were incredibly low, about $700,000 for the quarter.
That's 0.07% annualized. It's barely a blip.
It's essentially zero in this environment, and get this, non-accrual loans actually dropped 17% linked quarter. So the legacy portfolio isn't rotting while they focus on M&A.
Okay, this is what stood out to me. They're disciplined. They aren't just taking any loan that walks in the door. There was a specific comment about pricing.
Yes, this was a great insight. Management explicitly said they walked away from deals during the quarter because competitors were pricing 100 basis points lower.
Pause on that. 100 basis points. That's a full percentage point.
It's a massive spread. If EQBK is quoting 7%, someone else is quoting 6%.
What does that tell you about the competitor?
It tells you there are some desperate banks out there trying to buy volume. They are underpricing risk just to get assets on the books. And EQBK looked at that and said, no thanks.
Their new loans are coming on at, what, 6.77%?
Right, which is accretive. They would rather have flat balances than lock in 5.7% loans just to hit a volume target.
That discipline is crucial when you're promising the kind of earnings they are.
Exactly. And that brings us to the North Star metric they dropped on this call. Brad Elliott, the CEO, put a very specific number on the board for 2026.
The $5 diamond promise.
More than $5 per share in 2026.
That is a bold target. That is the anchor. That is what the street is going to judge them on every single quarter this year.
And to hit that, they need the Frontier integration to be smooth, and they need to hit their cost save targets. They mentioned a 23% cost savings target from the Frontier deal.
23% cost saves. Let's translate that for the listener. What does that actually mean?
It means aggressive cutting. I mean, you are talking of eliminating duplicate back office roles. You don't need 2 HR departments. You don't need 2 compliance teams. You close redundant branches.
It's messy work.
Very messy. And they expect the bulk of it to be realized quickly after that February conversion. If they miss that timeline, if those costs linger,
that $5 target is in jeopardy.
Yeah.
And if they miss it, the stock gets punished.
Yep.
Okay, let's zoom out a bit. Let's look at the investor context. If I'm looking at the KRE, the regional banking ETF, how is equity bank shares different? Why own this versus just owning the index?
Well, the KRE right now is filled with banks that are sort of paralyzed. They're playing defense. They're dealing with high deposit costs. They're worried about credit, and they're just trying to survive. EQBK is playing offense.
They're the shark in the water.
They are, and their capital allocation backs that up. They bought back about 172,000 shares in Q4 at an average price of around $41.69.
Which is a nice discount to where they are now, around $49.
It is. But Brad Elliott had a great line about this during the Q&A. He said, banks are sold, not bought.
I loved that line. Unpack that for us.
He's basically saying you can't force a merger. The seller has to be ready. Maybe their CEO wants to retire. Maybe they need a tech upgrade they can't afford. You have to wait for them to capitulate.
It requires patience.
Exactly. So their strategy is, plan A, buy other banks. But if sellers aren't selling, we won't just sit on the cash. We will buy our own stock instead.
And they have a specific metric for that, right? They earn back.
They do. It's very mechanical. If the earn back on a buyback is under 3 years, they pull the trigger.
I like that. It removes the emotion. It's just math.
It's a very rational approach. But we have to address the bear case. We saw the stock fade. Why isn't it trading at $60 if they're going to hit $5 in earnings?
Is it just the integration risk we talked about?
That's a big part of it. But there's also a technical headwind with the margins. specifically the immediate impact of the Frontier deal.
Explain that, because didn't we just say Frontier as assets?
It adds assets and it adds net interest income raw dollars, but Frontier's existing book has lower yields than EQBK's book. So while it adds dollars to the bottom line, it is dilutive to the percentage margin.
Ah, I see. It drags the average down. It's like pouring water into whiskey.
That's a perfect analogy. You have more liquid, but it's less potent. Management guided that NIM would likely dip into the 4.2% to 4.35% range in Q1.
And that compression scares people. Algorithms see margin compression and they sell.
Correct. Even though the absolute profit is higher, the efficiency metric looks worse temporarily. The bet is, I will accept a lower percentage margin for a much larger pile of assets and raw dollars.
That's the trade-off.
That's the trade-off, and the market's waiting to see if the math actually works.
Okay, so to summarize, we have a bank scaling rapidly, maintaining discipline, but facing a massive operational test in the next 60 days.
High growth, high execution risk. That's the summary.
Which brings us to our favorite segment. And before we start, the legal team makes us say it every time. This is absolutely not financial advice. We are not your broker.
Please don't trade your rent money on this. We're just reading the tape.
But we like to play a game where we pitch a trade idea as if we were analysts at a hedge fund. We call it the wild but plausible segment.
I love this segment.
So based on this earnings call, what is the trade? If you had to put money to work, how do you play this?
Okay, I've been thinking about this. I'm calling this trade the Prairie Predator pair trade.
I like it. Sounds aggressive. What's the thesis?
The thesis is that EQBK is the Pac-Man of the Midwest. They have a formula that works. But the prey, the small community banks, are dying a slow death.
Define prey here. What does a dying bank look like in 2026?
I'm talking about public banks with assets under $1 billion. They're in a trap. They can't afford the tech upgrades. They have entrenched management that refuses to sell. And crucially, they're seeing deposit flight because they can't pay the higher rates.
So they're bleeding slowly.
They are zombies. They are walking dead. They just don't know it yet.
So how do we structure the trade?
It's a classic long-short. We go long EQBK, that's your predator, and we go short a basket of these zombie community banks in the Midwest.
So you are capturing the spread between operational efficiency and slow death.
Exactly. Look at this setup. EQBK has a $5 EPS floor they're engineering. The zombies. Their net interest margin is getting squeezed to nothing.
What's the risk on the short side? What if one of the zombies gets bought out?
That's the kicker. That's the beauty of it. If the zombies actually do sell, who do they sell to?
Someone like EQBK.
Right. They sell to the consolidators. So if one of your shorts gets acquired, your long position EQBK likely benefits. It's a natural hedge.
Long the eater, short the food.
Exactly.
That is ruthless. But from a market structure perspective, it makes perfect sense.
It's an operational alpha play. It's not betting on interest rates. It's betting on the consolidation of the American banking system.
Yeah.
You want to own the ones doing the thinning.
And avoid the ones getting thinned. It's a compelling narrative.
And EQBK will be waiting.
All right, let's wrap this up. We saw a beat on the top and bottom lines. Asset growth of nearly 50%. A management team promising more than $5 per share.
A very confident management team.
But we also saw a market that sold the news. A market that is saying, I don't care about your promises. Show me the integration works first.
The next quarter is going to be critical. We need to see that Q1 print showing the Frontier assets on the books, systems converted, and costs coming out.
Scale is only an advantage if you can manage it. If you get too big and trip over your own shoelaces, it becomes a liability.
That's the risk. 2026 is the year Equity Bancshares proves if they are a compounder or just a collector of assets.
And we will be here to break it down when they do. Remember, do your own diligence. Nothing here is advice.
And keep watching the tickers.
See you next time.